Later in this video, I'll be showing you why I've actually bought this company even though the dividends are less than 1%. To be exact, 0.73% only. I'll show you how much I bought, I'll also show you at what price, so continue watching on. Hi guys, welcome back. Let's start with my current portfolio inside CDP. The value right now stands at more than 460,000, and inside this list, I've actually concealed the actual name of the stock I've purchased. So hopefully this does not become a buy or sell recommendation, but if you have followed this channel, you can kind of guess who they are. The first name over there is actually an industrial company, which I've recently covered as the top name in how I invest 100,000, and I'll leave links above if you have missed that episode. I intend to actually buy a bit more if the price comes down a little. The dividend yield for this company right now is at 5.5%. The second name in my CDP list is actually a hospitality REIT. One which I've featured many times before on this channel, and the current yield is 6.5%. I have quite a bit of this in my SRS account also. The third name is actually a food manufacturer, and price of this has actually came down quite a bit. That's because they manufacture chocolates, and unfortunately cocoa prices have skyrocketed, which may cause their cost of goods sold to increase quite a bit. Right now, this position is under stress, but as you can see over here, I'm still holding on to it. Dividend yield, 5.8%. The fourth name is actually a mall REIT. This REIT actually owns many heartland malls in Singapore, such as Next, Northpoint, Tiong Bahru Plaza. Current dividend yield, 5.5%. The fifth name is actually a hospitality company, one of the two owners that owns a casino in Singapore. Then is the sixth name, which is the company that I've recently purchased, and I'll cover them in detail for you to find a bit more. The seventh name on this list is actually in food sales. I purchased this quite long ago, and I haven't added to it because there's some cost pressures to its business. But nonetheless, it's still doing quite well and paying a 6.5% dividend yield. The next on this list is actually a data center REIT, which is currently my biggest holding. As you can see over here, 6% dividend yield, and right now, with my SRS holding, it's worth more than $100,000. If you'd like to find out more about it, I've actually shared my purchases in this previous video. I've bought $45,000 of Singapore stocks in 2024. The 10th name on this list is actually a mall REIT, one that owns VivoCity, and the current dividend yield is at 7%. Next on the list is actually a commodities company that owns tin mining. This share price has recovered quite a bit, so I'm very excited to see what develops in the quarters ahead. This is because tin price has risen, and tin is actually a very important component in the new economy. Then there's Singapore Savings Bonds, which I mentioned. I purchased 20,000 of it. And last but not least, a real estate company. This stock has fallen a lot. It was once my biggest holdings. I trimmed it a little bit and continued holding on to it. Current dividend yield is at 5.5%. So in total, you can see over here, total market value more than $460,000. Now, if you use 460,000 at 5.5% average dividend yield, then that will equate to around $25,300 of dividend income. Speaking to here, there are a few key learning points. And the first is there are no big swings. No risk on, risk off approach whereby I sell everything if I believe there's a market correction coming. No such thing. It's all long-term investing. The second, as you can guess, this portfolio was built up gradually. I've increased positions in things which I feel are turning around operationally. And recently, I've even added to the data center REIT itself. Every position that you see out there is as of a meaningful amount, other than the one blanked out in black. That was kind of like a mistake, and right now it's just too small to sell off. Always build positions that are meaningful, that you are willing to track. And the next part is don't have a list of 20 or 50 names of stocks because that's very difficult to manage already. I've always shared my journey transparently with you. As always, if you appreciate it, help me smash the like button. And with that, let me review to you what I've recently purchased. This company is none other than iFast Corp. iFast Corp right now pays quarterly dividends, as you can see in this table over here. The last dividend yield at 0.73 is because they've paid out only 26% of their earnings. That is why iFast is a high growth company. I've actually previously made multi-baggers of iFast, but I've sold off around $3, and that has always been a regret with me. That sale was before the Hong Kong eMPF win, which transformed the business itself. And just in case you don't know what is the Hong Kong eMPF win that it has, is actually like an e-pension system in Hong Kong whereby iFAST would make monies providing infrastructure as well as in-fund sales. That is a transformative win for the company, as shown in this share price jump over here. This happened in the start of 2021, and iFAST share price actually doubled in that process. As I shared with you, I sold out before this win after making multi-baggers, and I've quietly sat in wait for a chance to re-enter. After waiting for more than 3 years, I think it's time for me to finally start acquiring iFAST Corp again. The reason is quite simple. The Hong Kong eMPF is right now already bringing in profits. It's no longer just a contract in the future, it's a profit machine already. Fourth quarter of 2023 actually saw the first contribution, and share price actually skyrocketed 30% back then, from $6.50 all the way to $8.50. With every quarter of successful implementation and profits, to me as an investor, it feels like the risk of this eMPF project is reducing. Because if you see right at the very start, some are saying the timelines are very challenging. Some are saying that none of the existing technology is a perfect fit. So as implementation is coming into place, I do feel that the risk is dropping. That is why I believe around $7 is still a fair price to pay for iFAST. Let me show you some targets of what the Hong Kong would possibly deliver to iFAST. Again, these are targets, not actual figures. What we can see on the left are targets that were set in April. And what we can see on the right are updated numbers. On the left, it's quite clear to see that previously, the targets were even more ambitious. For example, net revenue target in 2025 was 1.3 billion Hong Kong dollars. But the revised targets right now are closer to 1 billion. However, the profit before tax targets was projected at more than 500 million Hong Kong dollars for 2025. The updated targets for this still remains, which to me is a very interesting proposition. 500 million Hong Kong dollars. If you convert to Sing dollar, it's actually about $86 million in Sing. So knowing this important detail, let me show you in terms of the valuation for iFAST. This over here is a quick snapshot of the profit loss per geographical segment. The top is contributions from Singapore. I drew a red line over there to show that this is not too much of a high growth sector. Singapore is a bread and butter place for it. It will grow, but probably in single digits. Then boxed up in green, you see that Hong Kong is the one that has jumped massively, correct? 2022, it was only at 8.07 million. And in just one quarter, it has quadrupled that for 2023. First quarter 2024 is already 13.23 million, even more than Singapore. Using this knowledge, let's adjust the possible profits for 2025 for iFAST. If indeed iFAST makes that 500 million of Hong Kong dollars in profits, could this segment be around $80 million from Hong Kong on an annual basis? Add the Singapore component, and that means the net profit could be around 100 million for iFAST. Using current share price at $7, this is about a 21 times price earnings ratio. What we can see over there is that, but the targets only suggest it's more than 500 million Hong Kong dollars. What if it actually overachieves? Could profits from Hong Kong segment be, say, 125 million Sing dollars? If it is, then price earnings ratio for iFAST could come down to 14 or 15 times forward price earnings at current share price. Comparing this valuation against Charles Schwab, which is someone they mirror against, we would see that Charles Schwab is right now valued at a price earnings ratio of 30 times. 14 or 15 times forward price earnings means that there's a chance that iFAST could actually hit a one bagger. Knowing this, I've been biding my time to accumulate, and I finally pulled the trigger, and I'll next show you what I've put the trigger on. As of 23rd May, I've actually made my first purchase at around $6.90 plus cents. Then when share price came down, I further accumulated this, and right now I own 2,000 iFAST shares already. I will be accumulating more if the results continue to hold strong. That's how I've built up my portfolio, adding one more quality name in. Right now the total dividend portfolio stands at more than 460,000, and it contributes to my net worth. This previous video I have touches on my net worth as of age of 39. Smash or subscribe because I'll be doing one for age of 40 this year, and check that out because it also reviews some other holdings I have in my SRS as well as my property assets. With that, I'll sign off from here and see you there. Take care as always. Goodbye.